Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into Phil's Tax Hacks and Other Retirement Facts with Phil Putney and myself, and we're going to talk about HSAs this go around because we haven't done that, Phil, and I think it's really kind of underserved. Great tool in the financial advisor's tool belt. And so that's what we're going to hit up this week. HSAs, health savings accounts. What's going on, my friend? How are you?
I'm doing great. Loving the fall weather. So
yeah, it's cool. As I never wear long sleeves, but it's getting.
I was going to say, you got the long sleeves going on today.
Know,
so
right?
Yeah.
Hey, so let's talk about this a little bit. Many people refer to them. I've heard a lot of advisors talk about them as a Roth on steroids, a
Super Roth. Yeah.
And so we've got an HSA, my wife and I. So it seems like it's a fairly common thing for more and more people have nowadays, but they don't really know what they can do for them and
what it is exactly, how it works.
Yeah, I think we think, well, we put into it from our job. And then we just use it when we go to pay our co-pays, and that's kind of it, right?
Yep.
There's a lot of stuff to an HSA, and it could be a really valuable tool.
Yeah, oh, absolutely. And I think often, like you said, they're misunderstood, misused. I mean, they're a huge planning tool. So
yeah. I thought it'd be good to just dive in and talk about what they are. And I've got some notes here, hence the glasses. So we'll see what's going on. So first thing I said, HSA, it's a health savings account.
Health savings account. Yep.
Yeah. Now there's kind of a cool thing about the tax, Phil. So let's talk about the fact that it's triple non-taxed. So can you explain that?
Yes. I mean, it's one of the, why we call it the Super Roth, is one of those unique vehicles that you get benefits on both sides. You get a deduction going in.
Right.
All the growth is effectively tax deferred, but can be tax free, just like a Roth. And the catch, though, is that it has to be used for medical.
Right.
So I mean, it's one of those vehicles that you get the deduction on the way in, and the growth is tax free on the way out too, including the deduction. So the money that you put in is deductible, and then they're not making you pay tax on the way out. Unlike an IRA, it's deductible on the way in, taxable on the way out.
Yep.
A Roth is not deductible on the way in, but not taxable on the way out. Well, this is deductible on the way in and not taxable on the way out. So you want to fund this thing as much as you can, because there's no other vehicle like it. So it's pretty incredible. And
we're going to get to that because there are limitations and stuff.
Right.
And it's also not a use it or lose it.
Correct.
Yeah.
Yeah. The most similar aspect that's been out there prior to this would have been the health reimbursement accounts, or HRAs.
Okay.
The use it or lose it type of concept. But yeah, that's one of the unique things, like a 401k, at the company, it's yours. It's a funded account for you. You get to take it. It's portable. So, yep.
Yeah. And this, again, it's a really cool vehicle. So let's get into some more specifics here. That was kind of just a general overview.
Yep.
Who's going to qualify for an HSA? Obviously, it's got to be offered by the company plan that you work for, correct?
Well, yes and no. I mean, so an HSA is a lot of times, especially if it's through a company, it's going to be paired up through the company just to make it easier for employees, but it doesn't have to be.
Okay. All right. Good to know.
But the catch to an HSA is that you have to have a high deductible plan.
Right.
It's not just a high deductible plan. It's got to be the IRS's definition of a high deductible plan.
Right.
So you can't think, that's a high deductible. I'm paying $500. That's high. Well, no, it's got to be what the IRS defines as high deductible.
And they are high.
Yeah. So their definition of high deductible at a minimum is $1,400 for single, $2,800 for family.
Okay.
So deductible, again, this means that 100% your responsibility until you hit these thresholds. Right. So they can be a bigger number. I mean, $2,800, you're thinking, why am I paying insurance premiums for? The thing that to remember in that, though, is that the difference is the premium is spent money. It's just gone, right? You're giving it to the insurance company. You'll never see it.
Right.
It is use it and lose it because it's just gone.
It's gone. Yeah.
Versus if you're paying less premium, you have more exposure through a higher deductible. Well, if you take that extra money that you would have been paying in premium and you put it in an HSA, well, now it's your money.
So you've got some little notes here. So not enrolled in Medicare. What's that mean?
Right. So yeah, you can't have any other health coverage, which includes Medicare. Okay. So you can't have a high deductible and in some other kind of a health plan to help cover it. It's got to be the high deductible plan. Medicare is not a high deductible plan, even though, I mean, technically, if you look at it, there's a lot of exposure, but it from again, the IRS definition is all that matters. It's not a high deductible plan. and this is where a lot of people get tricked up with Medicare, is that you can't have Part A or B coverage and qualify for a high deductible plan. So, if somebody's just going on Medicare like you traditionally might at 65, pretty easy, right? At 65, you're off, you're onto Medicare. It's prorated, so if you turn 65 July 1st, let's say, so the first 6 months you can contribute half of the premium, the HSA premium for that year, or contribution. Right. From that point forward, that year you can't. And this is where a lot of people unfortunately kind of get tricked up, is because if you're still working, let's say, you don't have to technically file for Medicare. You've got credible coverage. So that's the exception. You can stay on the company plan. You
can stay on it. Right.
But sometimes people think, well, Part A, there's no premium for it, so I'm going to go ahead and sign up. So they'll do that. And maybe the company might even encourage that sometimes, because then there could be some additional coverage and extra buffer there. So you're thinking, no, it's not a bad deal.
But
if you're on if you're on an HSA qualified plan, you've just kicked yourself out of the ability to contribute to an HSA. The other time that some people get tripped up with it is that even if you're delaying filing for Medicare because you're continuing to work, if you have filed for Social Security on or after age 65, it automatically enrolls you in Part A.
Right.
And you can't turn it off. So even at Medicare's, standpoint, it's not that the HSA is gone and I can't use it. It's you can't contribute.
You can't contribute.
It's your account.
Right.
You can still use it to pay for qualified medical expenses. So
it's still there and you still have that money. You just can't contribute anymore.
Right. But the key with all that is you have to really put some forethought into the election year, right? Because annually, every January, end of the year, you're making the election for the next year on your company's health plan. So if you're turning 65 next year and you're thinking of, filing for Social Security, let's say, and continuing to work, you make that decision up front, knowing that, okay, well, I'm not going to be able to continue to contribute to the HSA. So maybe you want to take a different health plan.
Well, and we talk about the complications of getting closer to retirement and you could just do the basic stuff that we all hear about. We could kind of do it. There's a lot of things where you can just kind of let it happen, I suppose. But if you want to be efficient, and that's what we're talking about, and that's one of the reasons we do the show, right? Is to say, hey, what are some tools out there to use and how can we use them to hopefully, better our retirement and better our retirement strategy and planning. So again, this is a great tool to do it. So a little strategy and then a little bit of planning and a little bit of working with a professional can help you kind of use this tool effectively and maximize it. Because most of us, like I said, we had it for a while and we were like, okay, whatever. And then we started learning more about it and we were like, oh, wait a minute, this thing's wait a second, there's some stuff in here. So
oh, absolutely.
Yeah, so let's talk about some of the advantage sides of it too. Then, since we just talked about the the kind of eligibility
qualifications. Yep.
So tax deductible premiums, including Social Security, Medicare, if payroll deducted. Okay, so what's that?
Right. So premiums that you're not premium, but the contribution, it should be, that can go in.
Right.
Is for a single $3,650, for family coverage $7,300, and this is for this year 2022.
Right. That's how much you can put in. That's
how much you can put into your HSA.
Yeah.
So it's your contribution into your HSA.
$7,300 for a family.
For a family.
Okay.
For individuals that are over 55, it's an additional $1,000.
That catch
now the little catch here is that let's say it's a family.
Okay.
So husband and wife, you can put in 73, and it can be in either or the spouse's names, right? So you can technically have an HSA just in one spouse's name that the whole 73 goes into. The extra $1,000 for being over 55 has to go into that individual's HSA.
The person that's over 55.
Right. So at that point, you now have to have at least another HSA for the person over 55 for their $1,000 catch up. So it's just and that's something to keep in mind in how you're doing. You can't put the extra, so both spouses are over 55.
Yeah.
You can't put an extra 2 in the one spouse's HSA.
Right. Yeah, that's a good distinction because my wife and I are 5 years apart.
Right.
And so I'll hit 55, obviously 5 years earlier. So that's a great distinction for folks that have that age gap. Now, anybody can contribute, as you mentioned, including your employer.
including the employer. So this is pretty common where employers will offer HSAs and will contribute some, maybe $1,000, $500, whatever it is to your HSA if you elect the high deductible plan, because it's cheaper premiums. So they don't have as much to cover.
It helps them on their back end, which is what we're doing. We're taking that because I have a history of heart issues and so on and so forth. We're on that that you referred to earlier, that super high one, and it's like woohoo. But it definitely has a lot of benefits to it. The funds roll over each year, which I think we talked
so
about
it's not a use it or lose it. You can roll it over. So it's your account, right? So it's not, and then there's really nothing you have to do with it. It's just there. It's like an IRA, right? It's your account.
Right. Now we talked about the tax-free deductions, especially, for qualified medical expenses, right? So let's break this down just a little bit more, but then I want to talk about the fact that you can also do things with it after. It doesn't have to be just the medical as well.
Right. So I mean, it's tax free if it's used for qualified medical expenses. I mean, you can look up on the IRS, website what that is. It's anything that would qualify for deductions on a Schedule A, itemized deduction.
And it's pretty hefty.
It's a lot. So think of, your dental, vision, out-of-pocket expenses for, your deductibles, co-pays, prescriptions, whatever the typical medical expenses.
Save all your receipts, folks.
Save your receipts, right? Or a lot of them will make it easy where they give you a debit card, right? So you can actually, if you're at the, your eye doctor's, just rather than pay with your credit card, pay with the debit card for the HSA if you want to do it that way. It can pay for medical premiums for Medicare, so Part B, C, and D, but not other medical premiums.
Not that.
So, if you're it can't pay for a supplemental plan, right? So if you're on Medicare, original Medicare plus a supplemental, it can't. If you're on a marketplace plan, it can't pay. You can't pay for the premiums for the marketplace plan out of it. A couple exceptions there. If you're on Cobra, you can pay for the premiums for Cobra. And if you're unemployed, you could pay for the premiums then. So premiums, even though technically, they're deductible medical expenses, gets a little muddy when it gets to the HSA.
Okay.
Long-term care premiums. That's another thing you could potentially pay out of here. Not the whole premium. Depends on your age, so
that can be a helpful bit.
Oh, absolutely. So 51 to 60, it's 1560 a year. So it's pretty small, but then it goes up. Age group 61 to 70 is 45.
That's
10, and then 71 plus, it's 5640 a year.
That's pretty substantial.
You could potentially fund long-term care premiums out of the HSA if you wanted to.
That's a great little tip there. I managed to really talking with your advisor about if that's something that's going to be on the radar, and you have one, and you're, like you said, 70, approaching 71. The Secure Act did some changes too, correct? Yeah.
So the Secure Act opened it up a little bit more, allowing over-the-counter. So certain over-the-counter deductions to a limit, as what would be considered a qualified medical expense. So, these are all things technically you could take out of it. Now, let's think it through a little bit further from a planning standpoint, because you could. And most people think of it that way of, okay, well, I'm funding it to pay for my deductibles, co-pays, all that. So put it in, you get the deduction, you get to use it to pay for those. That's great. And that works really well. To me, the better option is put the money in. As long as you can afford to cover those with your other funds, do it.
Okay.
And let that HSA just grow.
Right.
Think of it like a super Roth for retirement, right?
Right.
Because when you get to retirement, we all know medical expenses typically go up, right? It's a different world. You're seeing the doctor more, just part of life.
Yeah.
So you're probably going to have more medical expenses later. So it'd be nice to have this account knowing it's tax-free for medical later on.
To kind of build this bank, this HSA.
Right. So I think of it like it's a savings account for medical later on.
Okay.
So if you use it that way, then it's all still tax-free. Now, if you're over 65, you can actually take the money out without a penalty and pay taxes on it. So you could, if you needed it, take the money out. You'd pay tax on like an IRA.
It's still yours. You still have access.
Right. You wouldn't pay a penalty. And we didn't mention that. So if you do take money out and it's not a qualified medical and you're not over 65, it's a tax plus a 20% penalty.
Okay.
So you really don't want to touch this.
Really don't want to touch
it. For medical if you're not over 65.
Hang on to it for the medical and wait till we're over 65. Yeah. Okay.
But the real advantage that exists in these that a lot of people don't realize is that, like Mark was saying, save your receipts. Yeah. So let's say you funded this for 5 years, right? You're not taking money out. keep track of your medical expenses every year, get an envelope, whatever it is, keep track of it, just put it aside. 5 years down the road, something happens, and you need a lump sum of money. You got all this money in the HSA and you're thinking, I wish I would have done it. Wish I would have taken the money out. You can.
Yeah.
You don't have to take the medical expenses out of the HSA in the year it happened. You just have to have the documentation to prove that I had medical expenses in those years. So if you've accumulated, 5 years, 7,300, you got $35,000 sitting in an HSA, and all of a sudden you wanted 20 grand and you have 20,000 of qualified medical expense receipts, take it out. It's tax free.
Yep.
So again, it's a little record keeping, that's going to be one of the disadvantages. You got to keep track of it.
Yeah,
but absolutely. I mean, it's something that you can, after the fact, go back and pull money out if you need it. Because that's often where people think of the HSA. Yeah, but it's all tied up. I can only, only use it for medical.
Yeah. Yeah.
Well, yeah, but if you've already paid for all these medical expenses out of pocket and you have the proof, you can always get that money if you need it, if you really wanted it back. And use for whatever you want it.
And the money can be invested.
Absolutely. So it doesn't have to just be in a bank account.
Right.
And that's typically where it starts. It's in most banks are the ones that offer it.
Right.
But once, and it differs by custodian, but once you get above certain levels, usually it's around the 5,000 level.
Correct.
Once you have that amount in there, now they give you options of you can actually invest it.
And so, Phil, we'll wrap it up with this because we touched on some of the disadvantages. We talked about the high deductible, the growth, the penalization if you do take it out before 65. So we kind of touched on some of the negatives as well. Yep. I think we did a pretty good job all the way around on it. As a planner, as a professional, how often do you see these coming in, and how often do you recommend working with them or using them?
They're becoming more and more common. I recommend them, again, if it fits your scenario, right?
Yeah. Yeah.
The first qualification is looking at your use of medical care in the insurance, right? If mathematically it doesn't make any sense where you're going to be net out of pocket another $1,000 or more a year, it probably doesn't make sense to go the HSA route, even though, you can put the money away. It could. Yeah. But you're probably not, it's not to your advantage as much as it would be somebody that's not using it.
Yeah. We were kind of curious on that because we wound up getting into it and not really understanding it fully, and then wound up starting to have more medical issues than we realized. And maybe another option would have been better, but I think we've worked our way through it now and gotten enough knowledge that we've started to figure out how to use it more effectively, and it's become a really great tool at 51, for example. So I've still got a ways to go.
Yeah, and again, not to say somebody in that scenario is not the right situation. If that is your situation and you have enough resources to cover outside, then it could, because it allows you to fund this HSA for later on, knowing that eventually you could pull it back if you needed to.
Yeah. And for us, we started viewing it as, well, if I'm having these health problems, early on in the 40s and the early 50s, they're only going to be, compounded in the 60s. So let's go ahead and fund this bad boy. And then we've got something to make it, hopefully make that, easier when we get to that point. So again, I think it's a really useful tool. And so I wanted to get your kind of take on it and let you break it down, because we just haven't really talked much about them. And they, like you said, they are becoming more and more popular.
Yeah. So, we're entering that season where everyone's going to be, if you're still employed, you're looking at what the options are for next year.
That's right.
What are the options my company offers? Don't pass by that HSA plan. Look at it, run the math, see, it does. And that's the first thing I always look at is, what's the difference in the premium? So, okay, it cost me $200-300 less a month. Well, what's the difference then in my exposure? And oftentimes you're going to pick up more potential out of pocket than what the savings is. Yeah. Yeah. So if something really bad happens the first year, you might be upside down, right? You've got more exposure than what you saved. Yeah. But if, 2 years down the road, chances are mathematically you've saved enough now to cover if you do have a big medical expense and you hit the deductible. So worst case scenario, now the money's there if you need it. But,
exactly. Well,
don't get scared by the high deductible. Run the math, kind of run through the numbers, talk to an advisor if you have it, run it by them to see. Yep. But I definitely encourage you, if it's something that's available to you, if you can use the high deductible plan, do it.
Take a look.
Or look at it at least. Yeah.
Yeah. So, I mean, as you said, Phil, it is the season. So right now these things are going on where we're starting to look at this stuff. So if you need more information, if you're not using one or you're thinking about it, it's on the radar, whatever, like Phil just said, if you've got an advisor, not got an advisor, reach out to Phil, have a conversation about an HSA to see if it's the right fit for you, see if it can be a useful tool in retirement planning. Again, it's kind of called the Super Roth for a reason. Got a lot of advantages, got some disadvantages too. So make
like
sure
everything.
Yep. Make sure it's got the right fit for what you need. But that's the podcast this week. A little bit long, but thanks for hanging in there, folks, as we talked about a really important planning tool, another tool in the tool belt. So reach out to Phil if you'd like to. philstaxhacks.com. That's philstaxhacks.com. That's the website for the podcast that links you back around to the main one. You can also just call him at 248-888-7530. That's 248-888-7530. Don't forget to subscribe on Apple, Google, Spotify, YouTube, and we'll see you next time. Phil, thanks, my friend. Catch you later here.
Take care.
On Phil's Tax Hacks and Other Retirement Facts.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.